moving on to the balance sheet financial statement. The balance sheet basically is like your address. It tells you where you are. It's a snapshot in time of your financial situation. It details your assets, your liabilities, and your net worth, and we'll get into explaining how those are defined in a minute. You can make a balance sheet for your personal assets and liabilities, or you can make a balance sheet for business assets and liabilities. So assets, what are assets? Assets are things that you own, regardless of whether they're financed or not. We'll get to the financing piece later, but your assets are basically any tangible or even intangible item that you own that's in your name. So it could be real estate, it could be equipment, it could be inventory if it's a business. If it's your personal balance sheet, it could be like your savings account, personal property, that sort of thing. So next is liabilities. That's what you owe to others, and this is the finance piece that comes in. So if you have a house, for example, your asset would be the house and the real estate attached to it, and the liability could be a mortgage that's associated with that house. So the difference between the assets and the liabilities is your net worth. So if you, again, going back to the example of a personal balance sheet, if you had a house that's worth $200,000 and a mortgage that's worth $50,000, your net worth would be $150,000. That's $200,000 minus the $50,000 that's owed on that property. The result is your net worth is $150,000. So your net worth is not necessarily liquid assets. It's not necessarily cash in the bank that you can use to pay bills, but it's a measure of how much you have in your name, how much you own, less your obligations to other people or other institutions, and the balance is your net worth. So pretty basic, and the reason it's called a balance sheet is that your assets and your assets equal your liabilities plus your net worth. That each side of that scale has to balance. If they don't, then you made a mistake somewhere. So here's an example of a personal balance sheet. So here we have assets of $3,000 in savings, a car that's worth $10,000, and real estate that's worth $100,000. So we have a total of $113,000 in assets. Liabilities against those assets are credit card debt of $1,000, a mortgage of $50,000. So we have a total liability of $51,000. That leaves us with a net worth of $62,000. So pretty basic example. A balance sheet for a business could become much more complicated, but that's the general idea. So another important measure related to the balance sheet is your net worth percentage. So from the prior slide, we saw that we had total assets of $113,000, liabilities of $51,000, leaving net worth of $62,000. So the percent net worth is 55%. What that means is that 55% of my assets are owned by me, the value, 55% of that value. 45% is owned by my creditors, essentially. If your percent net worth drops below 50%, that puts you in a somewhat of a precarious position because it means that more of your assets are owned by your creditors than by you. If you have negative net worth, that means that you owe more than what you own. That beginning farmers can sometimes find themselves in that situation if they have things like heavy student loan debt or something like that. If your percent net worth is low or negative, it can be hard to secure financing. So just to review, your net worth is divided by your total assets is your percent net worth, which is an important financial ratio. The requirements of lenders vary by institution, but again, if you have a negative or a very low percent net worth, it may be difficult to secure financing. The good news is that some creditors do look at things like student loan or medical debt a little differently than they look at, say, credit card debt. So they may be a little more accommodating of a low net worth percentage for those reasons. But you want your net worth to be above 50% ideally.